Hello, everybody. Welcome to this issue of Update. I'm Rick Geiler with SilverSide Insurance Marketing here in Scottsdale, Arizona. Thanks for being with me here, and let's get started. Today's update is for agents only. If you don't have an agent or you're not an agent, please either forward this link to your agent or give us a call and we will find an agent in your area that you can work with. We're going to get into some product specifics today, so we're going to try to keep it a little close to the vest here. As in most of our updates, we like to get into a little bit of backdrop about what we're dealing with in the life and annuity business. And as our theme has been lately, it is low interest rates. If we see today's close for the 10-year note in Chicago, 1.62% yield on 10-year treasuries. So very low interest rates. You compare that against a 4% plus average over the last 40 years on the 10-year note. Very low interest rates. Also, S&P 500 closed back up a little bit today, but for the most part, we've just been banging a range between 700 or 800 and about 1,500 for the last 12, 13, 14 years. So high volatility, but really not a lot of trend in the stocks and the equity markets. So today, what we're going to talk about is annuities. And Life Health Pro has recently noticed that annuity sales have actually dipped the first quarter of this year. They've been consistently trending higher for at least a decade or so. And they slightly dipped. Let's see if we can analyze. Obviously, one of the reasons is with lower interest rates, we're having a harder time getting clients interested in moving money around to take advantage of rates that can be supported by a 1.6 Treasury, which most of our favorite carriers invest heavily in the Treasuries. So what are some of the other problems with annuities? And let's talk today particularly about indexed annuities, which generally run on 10, 12, 14-year chassis maybe, tends to tie the money up a long time. So that's a concern for a lot of our clients. I'm getting low crediting, and it's tying my money up for quite a while. Recently, a lot of the carriers have gotten clever in some designs on some income rider products that, although the base crediting isn't really super high, they have been able to pool risk and offer lifetime withdrawal benefits on riders that can add some value. And a lot of us have been selling a lot of these products. Several of our favorite carriers have come up with some very clever designs. But one thing I want to talk about today is we've all historically been quoting 80 to 90% of people don't take income out of their annuities. And I have a feeling that with some of the designs we've seen and some of the measures we've had to go to still show our clients some value in this low rate environment, that probably as time goes on, we're going to see that number drop a little bit. We're going to see, since a lot of people are getting into income rider-driven products, death benefit rider products as well, but the income rider-driven products, you're kind of marrying yourself to the income rider-driven annuity as opposed to your cash value crediting side is going to suffer. It's going to start out a little bit lower because the lower rates and caps that most of the carriers are offering, plus you got a cost of a rider dragging on that. So on your real cash surrender value side, you're not going to really see much growth in this environment. So what if you could offer an FIA without an income rider? And you say, Rick, what are you talking about? Of course I can offer one. The problem is it won't sell. If rates are low and benefits are low and I can't offer an extra benefit like a lifetime guaranteed withdrawal or a nice death benefit enhancement rider or something like that, it's going to be hard to get a lot of my clients very interested in a 1 or 1.5% fixed rate of return, especially if that's going to involve them tying their money up for several years. Well, I'm going to show you there's still some stuff out there, one product in particular, that we can still offer value without relying on an income rider. So let's take a look. If it's going to do that, it's going to have to address the two problems we talked about earlier, low crediting, and it ties up your money. Well, here I'm going to show a product, and I apologize for how busy this slide is, but there really wasn't a lot of way to get around it. I'm going to just, as you see, I put in 40-point font with red the features to this thing I really think we need to look at. 5% immediate interest bonus. That's fully vested. There's no gimmicks on that one. There is a 10% penalty-free withdrawal. To address any liquidity concerns, it accumulates to 50%. Very unique liquidity feature for an indexed annuity. If you don't take a penalty-free withdrawal after year one for 10%, you can take up to 20% after year two, 30% year three, and so forth, accumulates all the way to 50%. So after 5 years, you can take the full accumulation value, half of the full accumulation value, completely penalty-free. Very unique feature. Also, 2% on 100% of premium. You get a guaranteed minimum return. So I'm going to get into the index strategies and where you might want to allocate your money, but regardless of the performance of that, you have an overall 2% guaranteed rate of return. And this issues all the way to age 85 with those features. 5% bonus to 85, the 50% cumulative withdrawal, everything to age 85, and it has a 4.5 S&P 500 point gap. As you see, it also has a global strategy that can be pretty effective too. But I think the real eye catcher on this one, in this rate environment where we're seeing a lot of the premium carriers, a lot of the A companies out there have not been able to hold caps around 4.5. Most of them are around 3. And certainly 2% on 100% of premium is way better crediting than most of our favorite premium A category carriers have been able to maintain in this environment. So let's take a look at what else we have here. This is a 9-year surrender chassis. It starts off year one is 8%. It's 8% surrender charge, and there's no MVA. So if you take an 8% surrender for years 1, 2, 3, and 4, and you get a 5% bonus and a guaranteed 2% rate of return, I can show you an illustration on the company software, on the carrier software, that is going to show a guaranteed positive surrender value after year 2. So if you have clients who are sitting in CDs or sitting in cash, reluctant to make a move, hoping rates are going to go higher, hoping you can show them some value, and they're not interested in a guaranteed lifetime withdrawal benefit kind of product. And there's some very good ones out there, but if your client says to you, hey, look, I just have this money, I want to see it grow, and I want to have access to it if I need it. Well, this is where you want to take it. You want to take it to a 5% bonus, 50% cumulative withdrawal, 2% guaranteed. So essentially you're going to make between 2 and 4.5%, maybe more, because there's a par rate, uncapped global strategy, but let's say between 2 and 4.5% after 5% bonus in the most highly liquid indexed annuity on the market today. And I'm going to tell you right now, I'm going to go to my thank you screen. There are no gimmicks or tricks here. There's no yeah, but I didn't tell you this, I didn't tell you that. This is a quality company. This is an A category carrier from AM Best. They've been around 170 years, and they are not a huge annuity company. They do a lot of life business. But they have this annuity that's still out there on the market that offers some value, and it can help you get sales with reluctant clients who are reluctant to make a move because of the low rate environment, and they don't want to tie their money up. So, yeah, I'm not going to tell you on this video who the carrier is. I'm going to make you call me. Sorry, but that's the way it is today. Go ahead and give me a call. Call my office. Anybody there at SilverSide can help you. 480-998-1286. Thanks for being with me.